Good afternoon, everyone. Welcome to our briefing. I hope you're enjoying this fall temperatures in Augusta, Georgia. I still like the winters better than being up north. As y'all can tell, the makeup artist took a day off today, so I'm looking a little ragged. The bad thing about these Zoom meetings is you see yourself on screen too much, and I don't know who that old guy is looking back at me on screen. But anyway, welcome. We're glad you're here. We've gone to monthly briefings as always. Reach out to us with any questions or concerns. We're under the water paddling pretty fast and furiously trying to figure out what's going on and trying to help all of y'all. As always, I'm joined by Sharon Head today in the world headquarters of AP Wealth Management, and she'll be helping us on the technical side. Sharon, why don't you walk through your technical rundown on asking questions?
That is really scary that I'm our technical person, but anyway, yes, if you'll just find your toolbar, the main thing is we want you to be able to communicate with us during the presentation. So if you'll find your toolbar where the chat room is, and you can send your questions or comments to me or to everyone in the group or to anyone privately. So if you'll just do that, we'll take those questions toward the end, probably. Thank you.
Thank you, Sharon. And please do ask questions. We are not mind readers here. We try to figure out what y'all might want to hear, so we certainly want to know what's on your mind. If at all possible, we'll probably hold those questions until the end, unless we see something super pertinent to what we're talking about, but please do forward questions. It's really, just as an aside, it's really been amazing how these Zoom calls have really worked out. I've found that people oftentimes when we're doing one-on-one meetings pay more attention when something's on screen rather than up on my TV screen in the office. It's interesting. So today, what are we going to talk about? We're going to talk about our thoughts from our investment policy committee meeting. We're going to do a market update. We're going to talk about valuations. Is there more pain to come? Some sector performances. And then there's a lot of cash around, so we'll touch on that just briefly. So let me share my screen here and we'll get started. Let me share my screen here and we'll get started. There we go. Okay. So again, welcome aboard. Market update, what we're all thinking. As we always talk about, and I think it's really important, everything we do here is based on asset allocation and not security selection. That's where we create the most value and where performance and variations in performance take place. And as you'll see illustrated in what we're going to talk about today, that's never been more important moving forward. And then as always, also total return is equal to income plus capital appreciation. We'll talk some about income today, and we may touch on some of our portfolio groups down here at the bottom. But first, we want to talk about our thoughts from our investment policy committee meeting. And just as a reminder, our investment policy committee meeting is where we get together once a month and we talk about what we're doing, what's happening in the market, our positions in our various portfolio groups. Are they performing as they should? Are there any opportunistic things we ought to be doing? We also dig deep into a select group of portfolios that are illustrative of other portfolios. And we have some good banter and some good conversation on why we're here and what we're doing. So as always, before we dig into this, we want to use common sense in uncommon times. We want to stay diversified and have an investment plan. I think all of you who are clients or future clients of ours who are on the call today, you know that's important. We've talked about that. And we want to stay in equities. Despite the volatility that we've had, we know in the long run, equities are going to provide the best return, but the amount of equities in your portfolio is really the $64,000 question. As you can see in bullet point 1 there, we continue to favor an overweight U.S. equities over international. We think the U.S. is going to lead us out of this crisis. We do think that a strong or weak dollar will affect this moving forward, and we can talk briefly about that. The money that we spend or that we're giving away and the deficit that we have is going to affect the U.S. dollar at some point, We just don't know when, particularly in your relation to other currencies. And then the next bullet point, we're overweight cash over bonds. As you've heard me say since we've done these and in previous meetings, we've got historically low interest rates. And the US Treasury, which is the benchmark for fixed income, is still at about 0.7%, not 7%, but 0.7%, which is still at or near all-time historically low interest rates. So what do we gain by investing in bonds over cash? Well, we lock ourselves into some bond yields that may not be attractive long-term. We still do invest in bonds because we're not going to put all of our eggs in one basket, but we're overweight cash over bonds currently. When it comes to bonds, we value quality over yield. Now, I've mentioned that before, but we could go get some bonds or some bond funds where the quality or the balance sheet of the bond issuer is not as strong as others. When that's the case, they're going to have to pay higher interest rates to get folks to buy their bonds. Our philosophy has been, let's buy quality right now and make sure that we can get that interest payment and that there's no doubt about it. Inflation. Inflation right now is not a problem in the near term, but in the long term it may be. Certainly, at some point interest rates are going to have to go up, and that will be affected by inflation. But also the other thing you've heard us say many times before too, is we think tax rates will go up at some point, and that delves into some of the strategies we've discussed previously. So the market, what's going on? We've had a nice run over the last month. Since we got together last, we've had a really nice run as well. But volatility continues, and it will rule for quite a while. The uncertainty of what's going to happen is what makes these come up and go down. Just day before yesterday, retail sales doubled in May over what most folks thought they would be. The market shot up initially really high and then came back down a little bit. But it's surprises like that really we haven't had a pandemic in times like these, so no one knows what's going to happen. We're likely in for a W recovery, not a V or a U recovery. And the W illustrates a lot of volatility, lots and ups and downs before we get out of this. We're probably not going to go very low and then come up very slowly. And we're certainly not going to have a V where we hit the bottom a couple months ago and we're on a straight arrow straight up from a recovery. So we think it's likely a W. Let's get to some slides. One other thing before I skip this. Unemployment, which is at, I think, 16%, something like that right now. That's likely to stay in double digits until sometime into 2021. We're not going to get out of this really quickly. And Jerome Powell of the Fed, who has an awful lot of data at his fingertips, talked about that and spoke to that when they met, and he issued a statement a couple days ago. The markets did not react well to it, but I think justifiably so, because they have a lot more data than the rest of us do. So let's pull up a couple graphs here that I thought were really interesting and illustrative of some things that are going on, and it seems like folks react well to these. So valuations, valuations, valuations. This is a graph from 1998 to current time period, and fund managers were surveyed about whether we're overvalued or undervalued as a percentage. So if at 50%, half of the fund managers thought we were undervalued and half of the fund managers thought we were overvalued. So you can see back here in 08 and 09 when we had a really difficult time, a lot of folks thought fund managers thought we were undervalued. Here in December, basically, of 18, when we had a bad downturn, a lot of fund managers thought we were undervalued. Well, look at where we are now. This doesn't mean they're right or wrong, but 78% roughly or so think the equity markets are overvalued. So I think that bears watching. And although we've had a really quick recovery, what's driving that recovery? And I think that's the question on folks' mind as fund managers look at valuations currently. This one's interesting, and I titled it More Pain to Come. These are Northeastern states are among the top to see tax revenue shortfalls. So what this means is, in the example of New York, their tax revenue shortfalls are down 40%. So as you think about the state of New York, what do you think that means for them? Their budget, their income just got cut by 40 cents on every dollar. You can see where we are. Georgia's got cut by almost 35%. The reason I think this is really important is I think there's more pain to come from a local standpoint. This is going to filter down to local municipalities, and we're going to feel this. And we're going to feel this in what services are offered, particularly with the social unrest that we've had, and there's going to be a redirection of who knows what. I don't want to get into that too much, but this is going to be a struggle for many states because the federal government is trying to inject liquidity into the markets and may also affect what states' revenue gets. So I think this is something to bear watching and really pay attention to. Also, I think subsidies to institutions and smaller municipalities will suffer as well, because I don't think states are going to have the money to be able to give to local municipalities as well as colleges that they support. So we looked at a graph like this in the last few weeks or last month, and I thought it was a good time to check back in on some of these sectors and what's happened. Each of these bars represent a time period, and this time period, which is all negative, is from February 19th to March 23rd, and you can see everything was down substantially, energy being the biggest, materials, consumer discretionary, industrials, real estate, financials took a big hit, utilities, everything took a big hit. Then as we move from where we kind of hit bottom so far of March 23rd, the green shows the recovery from March 23rd to the 15th of June. And you can see great recovery in energies. The one that really bears looking at is consumer discretionary, because the liquidity or the cash that was injected into the market in the form of stimulus checks, that's what's driving a whole lot of this consumer discretionary spending, and continues to do as well. And I think that's why when you look at the blue from May 14th, basically from the last month, it's up 10% just in that last month. Industrials are up, real estate's up. So we've seen some nice growth there over the last month as well. And we compare this to what we looked at probably a month and a half ago. This is really interesting because have we gotten ahead of ourselves? I'm not sure, but just looking at energy, that's a mighty big swing there. And then we always hear this, but this is really interesting as well. This is an illustration of money market net assets from 2008 till right now. So in 2008, and this is the institutional folks, and this is retail. So this is individual money market accounts, and this is institutional money market accounts, okay? So in 08 and 09, when things were really scary and people moved to cash, you can see cash was at 2.5 trillion and 1.4 trillion. We are above that right now on an institutional standpoint as well as a retail standpoint. There's more cash on the sidelines now than there was during the financial crisis of 08 and 09. And I think that's telling for a couple of reasons, and it strikes me as really interesting for a couple of reasons. One, on the institutional side, they're making nothing. These assets are making nothing from an institutional standpoint. So institutional investors are going to their clients and going to their mutual fund investors and saying, we think we can do some good with this money, and we're willing to accept a 0.01% return rather than invest in something else, i.e. bonds. That's probably the flip side to that. The other interesting part about this is on the retail side, the money market side, folks are taking a lot, I think, of what they've been given and putting it in savings accounts. They're also not spending like the government, I think, would like to see them spending on the retail side. So I just thought this was really interesting about, one, how conservative we are, both institutional and retail-wise, when interest rates are as low as they are. But two, that we actually have more cash on the sidelines than we did in 08 and 09 from a dollar standpoint. Now, does that mean all of a sudden we're going to have a rubber band effect and people are going to jump into the market? I don't think so. I think people are just scared, and they're scared of the uncertainty both on the institutional side and on the retail side. So just a reminder before we move into the Q&A, some of the strategies that we've talked about still work. They're still applicable. Rebalancing, which if you're a client of ours, you've seen us do that some here recently based on what we discussed in our investment policy committee meeting. So rebalancing is incredibly important. The benefit of a Roth conversion is not quite as important as it was before because we've seen a nice bump up. But the really important part about that is tax rates will be higher in the future, and that makes it attractive, not as attractive as it was, but still attractive moving forward. And we've run some scenarios for clients who are on this call and walk through it. We can do that for anybody. We can run a projection on how that might affect you to do a Roth conversion moving forward. And then tax loss harvesting, we'll do that anyway. We always do that beginning in about October or November of every year, but there's a lot less positions to tax loss harvest than there used to be, which is a great thing. So I will open it up for questions now. And Sharon, do you have any questions that, I'll quit sharing this.
We do not have any questions right now.
Okay. I know we have some of the other AP Wealth Management team on here. Clayton, did you want to make any comments on anything that I may have overlooked or didn't spend enough time on?
I think you covered it pretty well, Gene. I mean, I would probably, just add that patience is prudence, and that's really been the key with all of this since this whole coronavirus thing kicked off and the markets had their big reaction, and we continue to revisit that. And I think that comes up in those investment policy meetings every single month, is that we just, we're using and keeping the strategies in place that we've had and that we plan for the long term, so we're feeling good. But we also at the same time don't want to make any knee-jerk moves or do anything. So we're just being patient and watching things unfold and take it day by day, because every day we move forward, we know a little more information. So I think that's probably what I would leave you guys with, is just continue to be patient, and this will all eventually, it's amazing. We talk a lot about, if you look forward 12 months, 24 months, I think it's going to be interesting to see what the history books say about this period. But I think we'll all be in pretty good shape and our goals will still be accomplished.
Thanks, Clayton. That's good points. Young minds are good to have around. I guess that I'll wrap up with this if we don't have any questions. Just be prepared for more volatility, and particularly when something big happens, whether it be there was some news today about a really cheap drug that will help stop the COVID virus, I think, or when testing or a vaccine comes out. That's going to drive the market up, and it's going to drive the market down if some of these things are not successful. Again, I'm beating a dead horse here, but if you were in the right place starting out and you've got a good diversification, there's no need to do anything rash. All of you who are on this call, I can see you. None of you, thankfully, gave us a call and said, I've got to get out, I've got to get out, I've got to get out, which was very wise advice, because you were in exactly the right place you needed to be. We can always tweak, and we're always doing that. We're always looking for opportunities, and we're always looking for things that maybe don't fit, looking at underlying expenses in the various investments we have. So trust us that we're always on the lookout here and trying to be a good sentinel for all of y'all. Sharon, I'll check in with you one more time.
We still don't have anything. I think you did a great job covering it.
All right. Well, terrific, y'all. As always, in the interim, if you've got questions or you were shy, please don't hesitate to contact us. We just wanted you to know what was on our mind. We're always here to take your questions, whether they're easy or difficult, and happy as always to walk through your portfolio and what's going on there. So with that, I'll sign off and wish everybody a fantastic summer. Please also, if you've got some topics you want us to cover in the future, we'll sign on again next month about this time. We're happy to cover whatever's on your mind. And if you've got feedback on what we did today, either positive or negative, please let us know that as well. Be safe, wash your hands, and now I think you're supposed to wear a mask as well. Thank you all and have a good evening.